Hey, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is February 22nd, and let's get started with reports. So stocks are having a pretty good day today, but as you can see, they've been really volatile over the last few weeks. Now, initial jobless claims did come out today. They were again lower, which is great for the economy. That means there's less people without jobs. And we came in at about 222,000, which is a 5-week low. But the other thing, guys, is we're actually near a 45-year low for unemployment claims. So this is really good news for the economy, but unfortunately, it is putting more pressure on bonds. The Fed also came out yesterday, and I'll show you the charts in a second, but you're going to see some pretty big movement yesterday. And Fed came out and basically had a few very strong inflationary comments which hurt bonds. And we all kind of assume this, but it's very likely that the Fed is going to increase the short-term rate in March. Now, there's a lot of confusion amongst consumers out there that the increase of the short-term rate has a direct impact on 30-year fixed mortgages. And that is actually false. So what we're seeing and what we saw yesterday because of those comments and because of the solidification that the Fed will increase the short-term rate, investors are already selling and adjusting their posture on bonds ahead of that Fed rate hike in March. So the rate hike in March will likely have a very minimal impact because investors are already foreseeing that rate hike in March on the short-term bonds and adjusting their position on these long-term bonds like 30-year fixed mortgages. Anyway, I hope that makes sense. Now let's get going with the charts. As you can see, this downward trading channel since early January, we're still maintaining it. We're still trading within this channel. I want to go back earlier this week and late last week. You can see we opened at the bottom of this trading range and had a pretty good day. The next day we traded even better, and it almost felt, if you're watching my mouse right now, like we were beginning to stabilize. Okay, and this is the Fed coming out yesterday. We opened right at the high end of this trading range, and look how defined this is, guys. Crazy, right? Very, very defined. We opened at the high end of this trading range, and then Fed came out, spoke, talk of inflation. Inflation is not friendly to bonds, and that's where we saw the bonds sell off. And so we almost touched the bottom of the trading range. Now today we're opening because there's not a lot of reports, just the unemployment. And so we're trading right in the middle of yesterday's trading range. But as you can see, we did not have enough steam yesterday because of the Fed minutes to break out of this downward trading channel. So here's where we're at to kind of quantify. Last month, we were trading on average, let's just say at about 103.65, this line right here. Current trading is at 102.23. That's a difference of $1.32. Okay. Now, Freddie Mac came out and said the average consumer last month in January got a 4.30 rate and it paid 0.5 points. So if we're trading $1.32 worse and they were paying half of a point, man, they're going to be paying closer to maybe 1.82 points estimated for that same rate. So just because of this downward trading channel. So anyway, let's get into the forecast. My last projection was a miss by 11 cents. I was a little bit too bearish on bonds, thinking that they would actually sell off a little bit more. So here's where we're at today. Right now, the analysts that I follow in a short-term range, they're a little inconsistent. They're both neutral and bearish. On the long term, they are very consistent and they're very bearish on bonds, meaning that they do think interest rates will or the fees for those rates will likely go up. And I have to admit, I'm really with the analysts that are both bearish on long and short right now. So here's my forecast. We're currently trading at 102.23. I think we're going to trade down to about 102.10, if not 101.50, if we can't break out of this channel. So that means if you have an opportunity to lock in right now, if it was me, I probably would lock in right now, just because I think there's more downward potential than there is upward potential. If you do decide to float, I would just say be very careful. Try to watch the charts intraday and see if we can break out of this channel. But we're going to be flirting with the top of this downward trading channel in the next 2 days. So I'm just really wary, and I think most analysts would agree with me. Probably the safest thing to do is float at this point. Okay, guys, that's it. Hey, we'd like to hear your comments down below. Have questions, we answer all of our questions. And before you go, don't forget to hit that like button. Sorry, I have to say it. And if you want to subscribe, click that guy at the top right. That will get you subscribed. It'll just send you a little update when we release new content. And if these charts and all of this stuff didn't really make that much sense to you, it's okay. At the top right, click Mortgage Bonds 101, and that'll teach you the basics that you need to know as a consumer to try to figure out the best time to lock in your interest rate. Anyway, that's it for now this week. We'll talk to you next week, and have a great weekend. Take care, guys.